Greetings, everybody. Welcome back into Mining Stock Daily. We're going to continue today with the corporate update from Ascot Resources. They are a longtime sponsor of the podcast. They continue to trade on the TSX with AOT and in the US on the OTCQX with AOTVF. Happy to welcome in from the company, Mr. David Stewart. David, welcome back in to the podcast. Good to see you.
Yeah, likewise, Trevor. Good to be on the show. A pleasure to be having on the show again.
Yeah, we got a couple of things. It's going to be pretty informative here regarding this rebalancing that's been happening in major ETF action in quote unquote junior mining. But first, before we kind of get into that nitty gritty, let's talk about some of the news that came out of Ascot earlier this week. You have you're refinancing the existing $10 million convertible facility here. David, I'll be the first one to admit to you, like once we start getting into convertible facilities, this is where I start getting lost. And so I'm hoping you can, kind of clear the air for me and tell me what I don't know. What do I need to know here?
Right. And I can totally empathize with that feeling as a mining engineer, sometimes getting into the nitty gritty weeds of convertible facility structures. Yeah, not necessarily my forte as well, but having gone through the process, certainly able to talk about it. And yeah, we're pretty pleased. What we were able to do essentially was take a $10 million facility that we signed up with BD Capital back in December 2020 as a part of the kind of original project finance package. It was 105 million US, and a smaller part of that was going to be a larger $85 million facility with Sprott Lending and a $25 million convertible facility with BD. We had drawn down on 10 million of that 25 originally when we kind of made that release, and we canceled the remaining 15 when we did the kind of project delay and refinancing announcement last year. And so what happened was we had the 10 outstanding, and it was in good status. I think when we refinanced Sprott Lending earlier this year with that $200 million financing announcement, which combined the stream with Sprott Streaming and also the equity investment from Coriapu, the Peruvian company. When we did that and we paid back Sprott Lending, BD Capital was kind of like, well, I mean, we technically we should be made whole as well. Like it would only be fair. But they did give us some extra time to figure it out, and they gave us until the end of this month actually to either, we were faced with, I guess, two options. And one of the options would have been to reprice the convertible note, the conversion price, because I think the original conversion price on that drawdown was somewhere around $1.53, which is about 3 times our current share price. So I think they were, that convertible was quite under the water in terms of its conversion price. So that was one option, and we saw that happen with a similar company. Integra Resources actually did a deal with BD, a convertible deal, and then later after the Millennial Precious Metals merger, they did a repricing of the same deal. So that was one option. The other option was for us to just find a different partner to buy it out completely and just reprice it into a new deal. And so effectively we chose option 2. Pretty happy with the outcome because it's broadly the same terms as the old deal, the old convertible note, with the main exception being we push out the maturity from what was originally December 2024 to now mid 2027. So we push out the maturity of that note well beyond the ramp up phase of the mine, because 2024, kind of a key ramp up year. Not necessarily a year that we want to be focused on things like paying down debt. And that's usually when you see these junior miners and junior developers struggle, is if there's any hiccups in the operation. Not that this transaction is signaling that we think there will be, but when there are hiccups in ramp ups and you combine that with a debt schedule, that's when things usually get pretty ugly. And unfortunately, we've seen a few junior miners in recent years go bankrupt because of that factor. So we already have very low debt, probably one of the lowest indebted juniors developers to be building a gold mine and go into production in the last decade. So a very strong balance sheet from that perspective. And then pushing out the maturity of even the small note that we do have, pretty solid for next year.
Yeah. And I know there's a number of people that are going to listen to this, and they come from all walks of life, and there's going to be parts of this conversation they'll understand, and some parts that they don't, and everybody's going to be a little bit different. So, let's kind of keep it as layman as we possibly can. So you took the 10 million of it is paid off BD. So this Nabari convertible facility was a total for what, 24 million? Is that correct?
14 million. Yeah,
14
million US. And that includes
Okay.
the accrued interest over the last 2.5 years with
Okay.
the BD facility, the prepayment fees and such. And so it's essentially all of it's going to be used to pay BD off
Okay.
and finance the new facility.
Okay. And can you, again, in layman's terms, describe to us the financial tool of a convertible facility? How is this used, and how does this work in this process up into 2027?
Yeah, that's a question that makes me regret not having Investopedia open on my other tabs. But essentially,
you may regret coming on the podcast now.
Yeah, essentially the way a convertible note works is treat it like debt, treat it like a loan. But instead of,
Sure.
in certain cases, the lender wants to be able to participate in the equity upside if that happens to be relevant. And so what can happen with a convertible note, it can be paid by cash, if the strike price has never quite met or the conversion price. But at a certain conversion price, which based on this note is a 20% premium to our recent share price, after that conversion price is met, then they have the option to receive the payment back in shares, which would make sense. It's almost like having a warrant or an option for a company's stock. If the company's stock doesn't go up, then you would just normally get paid it back in cash. But if it does go up and you want to participate in that premium, then you get paid back in shares or a mix of shares and cash. But generally, if the stock does well, you get paid back in shares. And so you get not just your original coupon back, but you also get all that equity upside that came from the participation in the market price of the stock. So it's kind of like treat it as a loan with the option for an equity upside.
Okay. And that would include that interest on that note. You could convert even the interest into shares.
Well, yeah, I mean, up until I think it was the later of December 2024, or sorry, the earlier of December 2024, or when we reach commercial production, which I think we would generally expect mid 2024, all the interest is accrued. And so that just gets capitalized. And then we start paying the interest on that.
Okay. All right. You know what? I'm glad I asked, because this is all stuff like I said, it's beyond me. But now we're all a little bit smarter. Well, that's good. So what's this going to be used for? I mean, obviously, BD's paid in whole. Nabari's now a major partner of Ascot here with the financing. What do you do with this capital? I mean, you're already well financed to get Premier up and running again. So what do you do?
So this isn't extra capital. The new facility is just being used to pay off the old facility.
Okay.
It's a simple refinancing. So we actually don't really see any of that cash ourselves. It just went to go to pay BD off. Yeah.
Okay. Awesome. How is production, or excuse me, construction going? We heard from Derek a while ago, so I'm sure there's more movement on the ground there.
Yep, and the movement's continuing to increase. Just last month, we mobilized our earthworks contractor, Nuna, which is kind of the key contract for the year between the months of May and October, working on the earthworks around what we call the Cascade Creek Diversion Channel and the tailings facility. And so kind of getting those dam toes up to a 2-to-1 slope. And yeah, ramp up has gone pretty well. The mobilization went well. It's kind of just a function of meeting the drill, blast, load, crush, deposit, and compacting schedules. And that's been going pretty well so far, but it's still pretty early in the season.
Okay, very good. So the big topic, or one of the big topics this week, David, has been this rebalancing in a couple of the major VanEck junior ETFs. We'll use the word junior with a grain of salt because there's no juniors in those ETFs. But you want to really focus on SILJ. In fact, Ascot was somewhat hit when that rebalancing happened. Was it last week or earlier this week? Kind of describe to us, what was going on and what was Ascot's kind of role passive role, I guess, in this whole thing.
Yeah, it was a bit of a scavenger hunt on a Friday afternoon trying to figure out what was happening. But essentially, I'll try to lay the groundwork and the context, and then we can kind of get into the play-by-play of figuring out what happened and why it happened, and how we moved forward. So, so yeah, you mentioned the VanEck gold ETF. So they have the GDX and the GDXJ. And yeah, you mentioned use junior with a grain of salt because like Kinross is in the GDXJ. It's like, well, they're not very J. But so the specific one that I'm going to talk about is the SILJ, the prime silver, the prime junior silver miners index. And it is distinct from VanEck. So it's a separately managed fund. There's an SIL and an SILJ. So kind of like the GDX and GDXJ, the major miners and the smaller miners. But this is the silver counterparts. And you might ask yourself correctly, what's Ascot doing in a silver ETF, a silver miners ETF? Because, well, we're not really a silver miner. We do have a byproduct of silver on our gold silver deposits. But why would we be in that ETF? And it's interesting. You look at there's 56 stocks in that ETF. And most of them are gold and copper companies. Almost a minority of them would be silver companies, because if you spent any time following the sector, it's actually very difficult to get any meaningful amount of silver mining exposure. There's a lot of exploration companies out there, but mining from revenue, most of silver is mined as a byproduct. And so a lot of the companies in there are, gold miners, copper miners that have byproducts of silver. The biggest companies in that fund are silver miners generally. But yeah, it's it was interesting for me to learn originally when I joined Ascot that we were in a silver ETF, because I was like, wait, but we're not primarily a silver company. Well, as it turns out, most of the companies in that portfolio aren't primary silver producers. And so you've got this ETF. I think it's about $1 billion in terms of market cap. And we didn't actually know this on last week until kind of like late Friday, but it was, the ETF was selling in a rebalancing, and it was selling the stock through Scotiabank. And we just saw these volumes coming out of Scotiabank, like, what is going on? And we were trying to figure it out because they sold something like 1.3 million shares of Ascot on Friday, which was well over 5x our normal volume. So it was pretty crazy seeing that happen. And we're trying to figure out like who's selling, what's going on, like. And I mean, the worst case scenario is that it's a large shareholder that we know, and they're just, for some motivated reason, they want out. Right. And that wasn't the case. So this was simply a secular mathematical equation that this robot ETF just decides I'm going to rebalance. And what's interesting about the SILJ is, unlike the GDX and GDXJ, where there's a lot of people following it, and there's a lot of people that predict what the rebalancings will do. And so with those GDX and GDXJ, you might have, Philo or Ascot, or you might have a bunch of companies added in a quarterly rebalancing, like 10 million shares, and like they'll spit out the formulas, and everyone will know this ahead of time. And so it kind of gets bought up or sold up before the news actually happens and before they do the rebalancing, which means that the rebalancing itself is a fairly immaterial event. But with SILJ, I'm not sure if it's a function of them not being as public with the mechanics of how the fund works, or maybe it's just a less followed fund. But regardless, I don't think many people knew what was happening on Friday. Certainly we didn't at the time. And they did a rebalancing where they bought up $80 million worth of a few companies, namely Pan American was like 35 million of that, Hecla, Buenaventura, a few larger cap stocks, and then the juniors just got sold. $80 million worth of juniors got sold, and Ascot got caught up with that to the tune of about 1.3 million shares, or about $800,000, which is, again, a lot for one day of trading. Right. So it just got dumped in the market. So we were down 11%, and we were freaking out, thinking like, what's going on? We did learn that it was the SILJ. We learned that it was an index rebalancing, and so that was a relief from us, because it had nothing to do with our story. It wasn't a motivated shareholder that was selling based on a sentiment-driven thesis. It was simply a mathematical equation that had to be rebalanced, and they do it quarterly. Usually, it's not that volatile, but this quarter, just the way the the weightings and the structure worked, it just happened to be a bit more volatile. So
So
we
do
tried to
they
get the
just
word out there as much as we could, because when that happens, like we had shareholders calling us and trying to figure out like what's wrong, what's going on, and so we got the
yeah.
message out, and that's part of the reason I'm talking to you right now, is to get the message out more, to try to calm some nerves and just be like it's not a sentiment driven major shareholder, it's simply an ETF, and unfortunately it's a double-edged sword. Sometimes that those rebalancings can be very beneficial in an illiquid market. Sometimes they can't.
So do they just sell these straight onto the market?
That's right. Yeah,
Wow. And no option for you guys to try to find a buyer or block trade or something like that? Not that they would be, I mean, it'd be hard to find, that'd be a lot, but at least to give you some sort of opportunity to get in front of this.
no. So yeah, what you're speaking of is generally something you'd be able to do if it was like a managed fund, like a
Right.
mutual fund or a hedge fund portfolio, where you could just tell the person like, look, I got this buyer, let's line it up. If you know it's coming, you can technically try to line it up, but I don't think anyone knew this rebalancing was coming, and certainly not to the volumes that it did.
Yeah.
So yeah, unfortunately, the ETF, like, they do the rebalancing, and it has to execute that trade by the end of the day, and it just gets spit into the open market.
Yeah. Dave, you kind of run this fine line between living and working in Toronto and visiting Vancouver I mean, you visit often. I've been hearing stories of funds been facing redemptions and having to sell a lot of positions in the last couple of months. The market's just really bleak out there. I mean, are you hearing similar stories? What is the status with some of those precious metals or junior mining funds out there that are kind of are they hanging on, or are they still pretty healthy?
I think it depends on who you ask, but more often than not, it depends on where you ask.
Mm,
So the sentiment that I've been hearing most recently is that Canadian funds just aren't there. Some American funds are. Um, I've heard that there's decent pools of capital right now in places like Europe or Australia or Asia, but North America, not so much. That's just what I'm hearing within the past week. But again,
mm,
that can change next week if you ask a different
right.
person the same question. But that's the sentiment that I'm hearing right now. Yeah, the market for financing hasn't really been open since at least a few months ago. At least not to a fulsome extent. We're seeing a couple companies come for like needs based financing, but I wouldn't describe the window as open in terms of funds participating in bought deals left, right, and
Hmm.
center. That's just we're not seeing that.
Yeah, interesting. I mean, it's usually darkest right before the dawn. I'm really hoping it's really dark right now for a reason. So, uh,
Yeah.
but
Well, actually,
hey,
with respect to financing, though, I'm glad you brought that up, because I forgot to mention a few months ago. So back in April, there was another very large volume day in Ascot stock. There was a day in April where we traded 25 million shares, which which is a lot of shares, and we knew something was up. And as it happens, 24 million shares was the exact number that Pan American Silver had inherited through their acquisition of Humana, because Humana bought that from
Ah,
us in 2021, 24 million shares, and they kept it. And then when Pan American bought Humana, they inherited those 24 million shares, and so TD did a
yeah.
block trade of 24 million. Again, it was a day. It was like an end of the day, and I was on the phone like, "What's going on? Like, who is it?" Turns out it was a secondary block trade with actually, and again, this was a few months ago, so maybe the sentiments changed, but it was primarily North American funds. We know
Hmm.
that one fund in particular took 13 million of those 24 million shares. So, and they were already a fairly large shareholder of us. I think they went from something like 4.5%, 5% ownership to 7, 8% ownership. So pretty
Wow.
encouraging. I mean, when you see something like
Yeah.
that happen, and you see your existing shareholders even step up in a bigger way, I think that was pretty encouraging for us.
Yeah. Well, I mean, it's usually it's a pretty good trade when companies get financed for construction. That's a lot of times people have that been in this business a long time and trading their capital. in junior developers, that's usually they find a really good time to buy is after financing is announced, and then there's a pretty solid re-rate as they climb out of that Lassonde curve. So I'm not terribly surprised, and we've already seen that happen with Ascot and its equity here in the last few months. So, but David, let's leave it at that. It's I guess thanks for the clarification. It's nice to have a better understanding of what's going on in those ETFs, and then also have a much better understanding on how convertible debentures work. So we're smarter people because of you. So thanks so much.
Well, trying. Unfortunately, I'm a mining engineer, so sometimes even these financial concepts are a bit out of my pay grade.
Yeah, a geologist, an engineer, and a financer walk into a bar, and you can understand where that conversation goes. All right, everybody. That's your update from Ascot Resources and Vice President of Corporate Development, Mr. David Stewart. David, have yourself a great rest of your week.
Thanks for tuning in.